Live from Tokyo, this is Insight with me, Sherry-Ann, where we dive deeper into the stories that matter with crucial context and analysis. Caution dominating trading in Asia as investors digest President Trump's criticism of Fed Chair Powell and await progress in tariff negotiations. Gold soaring to a fresh record and the dollar at a 15-month low. Coming up, we talk market strategies with Laffer Tengler Investments as the broad sell-off in U.S. assets adds momentum to the so-called Sell America trade. We'll also look at the impact of Trump's tariff war on the hospitality business and the U.S.'s appeal as an investment destination. Mandarin Oriental Hotel Group CEO Laurent Kleitman joining us later this hour. And the U.S. touts significant progress in trade talks with India as Vice President VP Vance meets with Prime Minister Modi. We'll be live in New Delhi. Another day, another jab at Jay Powell. President Trump again lashing out at the Fed chair and calling him a major loser for not immediately cutting rates. Trump has been repeatedly urging Powell to ease, warning that the U.S. economy may slow down if the Fed does not move quickly. Economists, on the other hand, widely expecting higher U.S. inflation and slower growth due to President Trump's own tariff policy. Take a look at how markets are trading at the moment because we have seen that skepticism and investor confidence hit really play a number on U.S. assets. We're talking about the dollar sinking, longer dated treasuries also declining. This is a picture across Asia, a little bit of a mixed picture, but this, of course, as we have seen some markets coming back online after Easter holiday. So you can see when it comes to the Hong Kong market, the Hang Seng Index right now losing ground a little bit, playing a little bit of catch down, but you can see some mainland stocks like the CSI 300 actually steady. The offshore yuan also holding a little bit steady, falling perhaps a little bit of pressure with the dollar, seeing some upside. The offshore yuan actually climbed after that weakening dollar trade really played into the broader currency space. The Japanese yen also holding very close to that 140 level. This, of course, after already climbing to the strongest level since September. We continue to see a stronger Japanese yen weighing on Japanese stocks. But it's really this sentiment around U.S. assets. What happens with investor confidence in this big market that's really rattling markets with ongoing uncertainty over how the trade war will unfold. Joining us now is Nancy Tengler, CEO and CIO at Laffer Tengler Investments. Nancy, great to have you with us. We have continued to see, of course, the gyrations, not only in the equity space with the dollar, but also in the treasury space. Are we seeing a fundamental shift in dynamics in the markets when it comes to veering away from American assets?
Well, we might be, Sherry, at least in the near term. I think one of the things that differentiates the U.S. market is kind of a predictable regulatory framework. And that has not been the case in the last few months. We've seen changes. First of all, super surprising announcements around tariff policy, and then changes to that policy. And then we've seen regulatory intervention as recently as today when the FTC went after Uber. And then we've seen the president come out and say, rail against Jay Powell. This is not the normal U.S. kind of market environment. And I think what you're seeing as a result of that is corporate CEOs are freezing up CapEx, and they're really shying away from giving guidance, which we would all do if we were running a company, because we don't know what's going to come next.
Yeah, and with this skepticism over U.S. assets, we continue to see the pressure on the dollar, right? The question of the day for our viewers today has been how low can actually the greenback go? And in turn, of course, fuel everything in the markets in turn, because it could really exacerbate inflationary pressures, which, mind you, President Trump is saying that there's virtually no inflation. So what are your expectations for the greenback?
Yeah, I actually wrote about this today, Sherry. It's absurd. So you have a weak dollar that will effectively import inflation. We've been importing deflation in a period where the dollar was stronger. Now we're in a mode where the Fed is worried about higher inflation pressures. The president, as you rightly point out, is telling us that there is no inflation, and we have a weak dollar, which will kind of wrap it up and ensure that we do have inflation if it continues for an extended period of time. Now, it will benefit some sectors like technology and materials, healthcare, that will benefit from a weaker dollar. But in general, a weak dollar policy is not a good policy. And so this is the chaos that we're all operating within in the US. And I wrote a piece today called Going to the Mattresses, which is an old reference to The Godfather, where in a war you hunker down and you hide, basically. And that's really what I think investors may have to do.
Yeah, I love The Godfather and your reference to the movie. But let me ask you about where the Fed stands in all of this, right? Because President Trump wants to see what he calls those preemptive cuts because he sees virtually no inflation. But what would the implications be if we continue to have these tariffs really on key trading partners for the United States?
Right. Well, so in the 90s, we had inflation that averaged around 30%, and we had a Fed funds rate above 5%. But because of productivity, robust stock prices were able to coexist with those higher numbers. I think what the market is contending with now is a president that's basically going to war with his own Federal Reserve chairman. So the market is predicting or counting on 5 cuts, or discounting 5 cuts in the coming year. This year, I should say. And I don't know if that's going to happen or not, because we have a Fed who said we're data dependent, which means they will be late, as they have been throughout the whole cycle. So how do you wrap all that up? I think what we may see is interest rates stay higher for longer. We'll see a frustrated president who lashes out from time to time, but that will not be what derails the economy, because high interest rates of 3 to 5 to 5% on the 10-year are not, they're not debilitating. But what will derail the economy is tariffs, because it's going to shut down CapEx and just all corporate activities. Pricing power, it will go towards dealing with the tariffs and not towards margins. This could be a very difficult period for U.S. stocks.
Yeah, and how will that really translate to the U.S. consumer as well? Because, of course, with a weaker dollar, their dollars will just not go as far as they did before. Not to mention that when we talk about yields rising, it's really the consumer as well that's getting hurt, right? Mortgage rates are rising.
Yeah, what's so interesting, though, Sherry, is that you saw JP Morgan, Citi, Bank of America, and American Express all come out just last week and say the consumer not only continues to spend, but even after, quote, Liberation Day, when the concerns arose around tariffs, the spending actually rose from the U.S. consumer. They're working despite market sell-offs and real estate declines, or at least real estate freezing up. Their net worths are still expanding, and the millennials are spending, and the Gen Xers. So that's an interesting factor that I think we have to take into account. It's a consumption economy, the U.S. economy. 2/3 is consumer spending, and so far we haven't seen that collapse. That may be kind of the silver bullet for the U.S. economy as we move forward. That consumers will continue to spend as long as they're working.
As an investor, though, would you be willing to bet on the American consumer under these circumstances?
Yeah, I mean, we've added to some of the consumer discretionary names, but selectively. So one of our largest holdings is Home Depot. It kind of gets tagged with the housing market, but generally speaking, people spend it in the U.S. spend at Home Depot, whether they're buying a new house or just refurbishing an old house. And oddly enough, $20 billion of revenues, it's almost twice as much as the next category at Home Depot, is spent in the garden center. So that's not really reliant on new housing. So we like the name. They continue to raise the dividend. And then we added to TJ Maxx, which is, a lower priced, but kind of, I wouldn't say high end, but medium end retailer that appeals to home goods and consumers that want to buy clothing, designer clothing at cheaper prices. And they just raised the dividend 13%. So we think, at your peril, you ignored the U.S. consumer. We think they're still relatively healthy.
At what point would you worry about foreign investors also exiting the U.S. market? Because about $19 trillion of U.S. equities, for example, are foreign owned. Is this concern about the future of the U.S., the future of haven assets like the dollar and treasuries going to extend as far as actually having implications for markets?
Yeah, I mean, I think it is right now. I think, Sherry, one of the things to pay attention to is that in the U.S., the institutional investor is at an historic low. The retail investor is kind of at a reasonable or median kind of level. And then what has been filling in the gap is the buyback desks of corporations. They're in a quiet period right now. So you're not going to see a floor under U.S. equities, at least being provided by corporate buyback desks. So you have to rely on the retail investor who is fairly reliable, and then the institutional investor, which has been skewing their allocations to fixed income for a decade. So if we add to that foreign investors are pulling out, I mean, supply demand would argue that U.S. equity prices are going to go lower.
And Nancy, are there any safe havens in terms of some sectors that the U.S. government wants to focus on? We have seen a lot of interest on critical minerals, for example, as a matter of national security. Would there be any sectors that you would like to hold now because of the potential of getting government support?
Well, that government support, Sherry, has been pretty fickle. But yes, I mean, you've seen copper rally. We know that the U.S. needs to play catch up in the rare earth minerals segment. But also what we know is that a weak dollar benefits technology, materials, healthcare. And so we've been trying to find the names within those sectors that we think are going to do well in any environment. And then in addition to that, we've added to names like Spotify and Netflix, which are not completely recession proof, but somewhat so, because they seem to be the last part of the budget in a family that will be cut. So that has been where we have been focused in terms of overall weightings. And we'll see. I mean, we still have a pretty risk on aspect to our portfolios. And so we've been adding to those names as well. And we hope, as is often the case, that if you barbell your portfolio in a situation like this, you will be happy down the line.
Does adding risk also involve perhaps overseas stocks? We've seen a lot of optimism about Europe and their spending plans over there, not to mention that perhaps emerging markets and some sectors of those EM spaces could actually provide some relief.
Yeah, I mean, I think, Sherry, I think those are trades in a portfolio. But if we see some resolution in the U.S. to this trade tariff sort of conundrum or whatever you want to call it, I think the U.S. market will take off, and that will be where net new dollars will go. Because at the end of the day, the innovation, for the most part, not exclusively, comes in the U.S. markets. And we believe the AI trade is still alive and well because we're seeing it seep into every sector, whether, non-old economy companies, non-technology companies that are embracing these new technologies. And so we do think you want to stay long the AI trade. You just want to be careful and be deliberate in adding to holdings.
I know that you hold some Nvidia as well, so I want to talk to you about that. Nancy Tengler, CEO and CIO at Laffer Tengler Investments, is actually sticking around. We'll take a closer look at Tesla as well. So ahead this hour, we'll be speaking with the CEO of Mandarin Oriental Group about the hotel operator's growth plans as it faces rising global trade uncertainty and pressure on consumer spending. This is Bloomberg. You're watching Insight. We're keeping an eye on Tesla's Asian suppliers after the EV giant stock fell sharply on Monday. Wedbush Securities analyst Dan Ives says the company is facing a code red moment as it prepares to report first quarter earnings. He also thinks CEO Elon Musk should step back from his government work and refocus his attention on Tesla. Ives recently slashed his price target for the stock by 43%, citing a brand crisis created by Musk and Trump's trade policies. Nancy Tengler, CEO and CIO at Laffer Tengler Investments, is still with us. And Nancy, I know that you hold Tesla. Are you concerned about how permanent the brand damage could be?
I am. I mean, Dan Ives is a friend, and he is by far the hammer on this stock globally. And he is right. I mean, I think what we need is leadership and focus from Elon Musk. Anyone who's read his biography, however, knows that, as he describes himself, he's wired for war. And so whether or not he steps back in the near term is debatable. We'll find out tomorrow. But I think what investors need to understand about Tesla is since the IPO in 2010, stock's up 15,000% or 40% a year. And 50% of the time, that stock has been in a bear market. It's volatile by nature, by definition. This is an unusual time, and I hope that what we hear from him is that he will return. But we're really focused on the energy business, because we think that's one of the things that's going to drive earnings going forward. And then, of course, the AI aspects of the company, which is full self-driving, among other things.
How do valuations look for Tesla right now?
I mean, Tesla's always traded at a lofty multiple. And I compare it to Amazon in the previous generation of names where, there weren't earnings, but the stock continued to outperform because people bought into the story. And part of the story, as Dan points out, is Elon Musk. So I think what we need to hear tomorrow is some certainty around when he'll come back or how he will be focused going forward, because that is what investors are paying for. It's a narrative stock. It's not a meme stock, but it is a narrative stock. So I think investors really need to understand where his focus is going to be in the coming years. And mind you, Sherry, there are a lot of levers to pull. There are, you've got Optimus, you've got full self-driving, you've got the energy business, which has been growing at 50% quarter over quarter, or year over year, I should say. It was 100% last quarter. Those are important components of the story, but you still have to sell electric vehicles. And that's one of the areas where the company has obviously been slowing down, and the brand damage has come to play.
Nancy, I do wonder, though, given, of course, all of this uncertainty over the trade war, how important are earnings guidances, not only from Tesla, but also other companies as well, when visibility seems to be so poor?
Yeah, no, it's the perfect question, Sherry. If you were a CEO, or if I were a CEO, why would we provide guidance? We have every excuse not to, because we don't really know what's coming down the pipe. So I think what investors are really focused on is where can they get information? Are margins deteriorating? Are companies seeing earnings or revenues fall off the cliff? And so far, and of course, earnings are backward looking, but we aren't seeing a lot of guidance pulled. We aren't seeing huge, increases or reiterations, and it's by far a small sampling size so far. But what we are seeing is management's kind of being prudent, stepping in the gap. I mean, we saw the bank earnings were good. The guidance was decent. We saw decent guidance from J&J. So I'm going to really be paying attention to this week and next week, because we're going to get a lot of the Mag 7 names. And of course, tomorrow we get Tesla.
Yeah, we are, of course, also watching Nvidia very closely, just because you hold the stock, but also the broader semiconductor space, right? I mean, we are still not very sure at this point what the tariff implications will be in this sector. So what is the rationale and the logic behind really backing this stock at a time when there have also been concerns about perhaps cheaper AI models being feasible?
Yeah, well, I think, Sherry, one of the things that investors need to pay attention to is, I don't know, nobody knows what the E is in the PE multiple, but we have an idea that the company has a huge backlog, Nvidia that is, and earnings growth despite the H20s being canceled or banned from export to China. We have an understanding about where earnings will probably come in. And if you look at that on a price earnings to growth basis, the stock is selling at like 0.5 per times. So less than 1 times earnings growth. So I think that has been a compelling level for almost any stock. Our largest holding in the space is Broadcom, which we have historically called the poor man's Nvidia. It has held up much better than Nvidia in this environment. But if you see AI spending return to growth, or we get clarity or a visual on that growth, you will see Nvidia take off. And this has been a historically good time to step into the stock.
When it comes to the broader semiconductor space as well, given that we still don't have that visibility in terms of export restrictions that you mentioned, are you looking at the supply chain and the consequences of that when it comes to broader global tech names as well?
Yeah, and we are, of course, and I think we still don't know what that is going to look like. And that's one of the areas where I think the Trump administration has done a very poor job on rollout. I mean, in my 40-year career, this has been the worst or the most botched policy rollout than I have ever seen. And it's just added to the chaos and the confusion. And markets don't like either of those. So I think what we hope to see what we hope to see is an understanding from this administration that you can't move your supply chain overnight. I mean, Taiwan Semi is building plants, a giant factory here, a gig factory here in Arizona, and it's been almost 3 years before we saw any chips being produced. It takes time. It takes a tremendous amount of capital expenditures. And so I think this administration would be wise to listen to these CEOs.
Nancy Tengler, CEO and CIO at Laffer Tengler Investments there, as we're now keeping our eyes on breaking news at the moment because the offshore yuan 1-month funding cost in Hong Kong now has fallen to a record low. We have continued to see really the downside pressure even as benchmark rates have risen, of course, in Hong Kong. We continue to watch right now the offshore yuan's 1-month funding cost in Hong Kong falling to that record low. We have seen a lot of volatility when it comes to the broader currency markets. We are continuing to watch the Bloomberg Dollar Index also erasing some of those earlier gains to continue to trade around 15-month lows. We have seen the other side of that trade, of course, with a little bit of upside for the Chinese yuan, but also for the Japanese yen, which is now headed towards that 140 level against the U.S. dollar. We're watching other currencies like the Aussie as well, gaining 0.3%. Coming up, we hear from Suntory Holdings CEO Takeshi Niinami on the challenges facing Japan in its trade talks with the U.S. This is Bloomberg. Welcome back. You're watching Insight. Mainland markets now going on its lunch break. We have seen some stability when it comes to the CSI 300. The Hang Seng Index still under pressure, 0.4%. We have just seen the offshore yuan's 1-month funding cost in Hong Kong falling to record lows. Really, basically, the funding cost in the offshore market at a record low, perhaps indicative that the yuan supply is ample in the markets right now. You can see the weakening against the U.S. dollar as we continue to see that greenback really under pressure, continuing with the overnight session. Now, at 15-month lows. And you can see on the other side of that trade, the Japanese yen really pushing towards highs that we haven't seen since last year. Take a look at some of those assets that we're watching, including the Nikkei, which is now going on its lunch break unchanged. You can see the fluctuations throughout the day today. We're watching one stock, Nomura, agreeing to acquire Macquarie's U.S. and European public asset management business for $1.8 billion in cash, the most significant overseas acquisition for this company since it bought Lehman Brothers assets back in 2008. Now, I was trying to really gauge the business significance of everything that's happening with the trade war and the tariffs coming from the Trump administration. Of course, the ongoing negotiations between Washington and Tokyo is something that we'll be watching this week. I spoke with the CEO of Japanese beverage giant Suntory Holdings, who says the current situation with the U.S. tariffs is really concerning. Takeshi Niinami explained why he sees the additional levies hurting both the American and Japanese economies.
If the current tariff negotiation continues as it is, we will be perhaps impacted negatively, perhaps from 1% to 1.2% against GDP negative.
That's for Japan.
Right. So that's really concerning, especially like Hiroshima, where Mazda is operating. They would lose lots of jobs.
Yeah.
So we have to be really anxious, and we are.
And we're not even talking about the U.S. economy, which could also obviously face inflation. Are you seeing any changes in your business?
Yes, I think definitely consumer confidence has been waning tremendously. And consumers are not spending willingly nowadays, so they go to the economy instead of the premium products. So that's really concerning too.
You're already seeing the shift in consumption trends towards affordable products.
Yeah, right, that's right.
The thing right now is that President Trump really wants these tariffs in order to bring investments back to the United States, in order to bring supposedly jobs back to the U.S. How difficult is it for businesses to make those commitments in the U.S. market when it's so uncertain? Well,
under the current situation where U.S. economy might go into the recession, it's harder and harder, right? If the economy is good just like before, around the time, the U.S. productivity is pretty high, above 2%. That's why U.S. attracted investments from the world. If that situation continued, we would have a strong appetite to keep investing in the United States. So current tariff situation is losing the appetite from other countries to the United States. So this is really, killing the appetite from the world to the United States. So we are losing the appetite to invest in the United States. As a matter of fact, if the economy goes into the recession, right?
Basically, what's happening is that, at least for now, these tariffs could be backfiring on the health of the U.S. economy.
Exactly.
The logic from the Trump administration is that he wants to change what they call unfair trading practices. Are you concerned long term that this might be an end to rule-based globalization, free trade?
Not really, because Japan and other countries are promoting CPTPP, for example, and RCEP. And China is another locomotive to promote free trade. So whether it's a good thing or not, I think we will be promoting the free trade in, for example, APEC, including perhaps eventually India. So without the U.S., some countries, including Japan and China, we want to promote free trade.
Can the rest of the world carry the global economy without the world's biggest economy?
I think so. This time, a lot of countries got understood that the U.S. is not the country to support the free trade. And the U.S. denounces the free trade. Bringing the bad situation to the United States. But the free trade creates the, good job creations and, world trade, in history. Lots of innovation happens. So I think Japan should be a flag bearer of free trade, and we will.
Suntory CEO Takeshi Ninami there on concerns about not only the U.S. economy, but just the global economy in general. We are going to get some more expectations of where growth goes from here from the IMF, not to mention, of course, PMI numbers from Japan, the U.S., Europe as well, with really that first insight into the manufacturing and services sector worldwide. These economic concerns likely to hit, of course, travel, tourism as well. Despite all this, Mandarin Oriental Hotel Group is aiming to revamp its founding flagship properties in Hong Kong and Bangkok. Let's bring in CEO Laurent Kleitman joining us exclusively in our Hong Kong studio. Laurent, really great to have you with us. We just heard from the CEO for Suntory talking about some rethinking of his business strategy globally. Have you had to do any of that considering, of course, the ongoing trade war?
So perhaps I'm going to bring some more positive news to your morning, Sherry, and that's great because hospitality is a long cycle industry, and therefore we've been here in Hong Kong for more than 60 years and in Bangkok for 150 almost. So we take a long-term perspective, and when it comes to our founding assets in Hong Kong here, the Mandarin, and in Bangkok, the Oriental, we keep investing, and we announce here that both hotels will undergo significant renovation in the next cycle. So we're going to put more than 200 million to really step into the next cycle in the next decade. So I take personally a very long-term view, and I'm very positive about the momentum in Hong Kong, in China, the momentum in Asia overall. And I believe, there are some maybe short-term difficulties, but I believe our clients still look for exceptional hospitality experiences, and this is what we'll provide by investing in Hong Kong and in Bangkok, as you see now on the screen. So this is a very good cycle for us ahead.
But Laurent, many would argue that if you're actually looking at the long-term implications, an economy like Hong Kong that has suffered not only from COVID-19, but social unrest as well, might not necessarily be an attractive destination. So why are you doubling down on this economy?
Well, in fact, it is a great destination. I mean, if you look at the numbers for last year, we're almost back to 70+% to what it was pre-COVID, and almost 90% in terms of inbound arrival in Bangkok. So we have a stunning increase in long-haul flights coming to Hong Kong, plus 50%. So we definitely see a resurgence and an increase of tourists and travelers coming to Hong Kong. If you've been here last week, with the Rugby 7 and the Art Basel, you'd see that the city has never been as bustling and active as ever. That's why we put money in Hong Kong to renovate accommodations, to increase the culinary experience, bringing new chefs, bringing new designers from all over the world to help us to create an exceptional experience in our two flagships hotels in here Hong Kong and in Bangkok as well.
Talk us about Bangkok, because of course we have seen the potential of 36% tariffs on Thailand as well coming from the Trump administration. Does that not give you any pause about the future of that economy and just broadly in Southeast Asia, given, of course, the ongoing concerns also about the potential hit to China and Chinese travelers?
So, in fact, that might be certainly impacting the short term. I still believe these are extremely attractive destinations. If you think, just to say an example about the culinary world in Bangkok, in less than 3 or 4 years, there's been more than double the number of Michelin star restaurants, which means that the city is definitely a key capital city of the world for culinary excellence. And we're bringing in our hotel in Bangkok, in the Normandy, we're going to bring Anne-Sophie Pic, who is the most awarded female chef in the world. So you see that we have plenty of confidence to actually bring and continue to shine in Bangkok, as we have done for 150 years. So I'm also confident about the Southeast Asian economy. I've announced earlier last year an investment in Bali. We have significantly redone our hotel in Singapore, and we are investing also in our hotel in Tokyo. So I do see, in fact, Asia and Southeast Asia for the long term still as an extremely important destination for global tourism and global travelers.
Do more investments across Asia mean that you're perhaps funneling a little bit of what could go into other markets? I know that 9% of your total revenue, for example, came from the U.S. last year.
So it's true in a way that we're probably less exposed to the U.S. than we should. We're, of course, looking at expanding in the U.S., but we're expanding very fast in Asia overall. We have announced a second property in Japan not long ago. We are expanding very fast in the Middle East, which is a very strong region as far as global tourism is concerned. And we're very strong in Europe as well. So I continue to invest, including in Europe, where we've just taken over a magnificent hotel in Paris, our second hotel in Paris, the legendary Lutetia Hotel. So you see that we are really developing a well-balanced global expansion strategy that will lead the group to double in size in the next 10 years.
And you're still investing in the U.S. You're not expecting perhaps a recession or a slowdown in consumption in that economy in the short term?
Well, I think our guests and the level of ultra-luxury experience we provide, probably our guests will still travel around the world in our properties and in the U.S. We have announced a redevelopment of our hotel in Miami that will close soon and be redeveloped into a stunning hotel and residence in Brickell Key in Miami. So we are definitely continuing to invest in North America as a whole. That includes Caribbean, but that also includes Mexico, which is a very attractive market for the region and globally. So, no, as I said, Sherry, we really approached growth as a global growth. Mandarin Oriental is a global brand, of course, born out of here, of Hong Kong and Bangkok, out of Asia, but really has branched out to the world in the last 15, 20 years. Today, we're running 43 hotels and 18 residences, and we have a pipeline of another 32. So we really have a very strong growth program ahead of us. Of course, bearing in mind the ups and downs of regional tourism, but I believe I bring more optimism to your show this morning than perhaps pessimism.
Thank you so much, because we really need that optimism these days. I mean, we continue to hear all this gloom and doom, right? At least it's interesting that you say the luxury segment might survive and might be a little bit immune from what we could see in the broader markets. When it comes to the changes in consumption behavior from travelers and tourists, what does that mean when you have potentially fewer Chinese travelers as well, and the world becomes more bifurcated, whether it's because of these trade relationships or just social and cultural relationships as well?
We have seen an increase of Chinese tourism back in Asia. So in our properties across Asia, we see Chinese tourism coming back, or business travelers as well, so which is encouraging. It's true that Chinese have not yet been back to Europe as they were a while ago. I'm sure they will eventually over time, but this is also why we have properties around the world, and regional tourism is as good as international tourism. So we are providing experiences for Chinese across our property. We have opened a beautiful second hotel in Beijing, a very traditional hotel in Hutong area of Beijing. And believe it or not, Sherry, we not only have travelers coming from other regions of China or from abroad, but we have also people from Beijing wanting to do staycation in our magnificent hotel in Beijing. So tourism these days, many things. Guest needs are very diverse. And the role of a brand like Mandarin Oriental is to provide these exceptional experience, whether it's next door or whether it's 10,000 kilometers away.
I was going to say, so do you still see that pickup and that need for domestic tourism within China itself? Are you still seeing that as a key market? Because when we continue to talk about these trade wars, we're thinking that this is eventually going to affect the Chinese domestic economy.
So we do. I think it's a great question. We operate today 10 hotels in China, in Greater China, and we have another 6 or 7 in flight. So showing that we are, of course, careful in our expansion, but nonetheless, for the right destination and for the right product, we are very encouraged by local high-end tourism in China. Chinese travelers are very discerning. They're extremely keen on culinary experience, on wellness, which are two forte at Mandarin Oriental. And the example of Beijing Tianmen property we've just launched is absolutely on that confidence of domestic tourism, including in China.
The bifurcation of trade routes and the ongoing really tit for tat when you look at how Beijing and Washington are really dealing with these ongoing trade negotiations. Is there any material impact in the hospitality sector when it comes to supply chains, whether it's providing some hotel goods or broader services as well?
I'm sure, Sherry, everyone around the world is consulting crystal balls as we speak. The reality is that we don't know yet exactly what it means. There might be an increase in cost for building hotels. There might be a slightly short-term impact on travel from Americans to Europe. But overall, I strongly believe hospitality being that long cycle industry, we will recover from that. You know, luxury, the true luxury is time. So providing great time for guests around the world. And in fact, I really believe we're in the happiness industry is definitely going to be eternal. So I'm taking a positive spin on whatever happens in the world. And even more, when it's gloomy out there, just come with us, have a great stay, enjoy a great meal, and enjoy an exceptional experience with Mandarin Oriental.
We love that. That PR pitch from Laurent Kleitman, but also just that optimism when it comes to the travel sector at a time when we really are seeing that really doom and gloom around the world. But CEO of Mandarin Oriental Hotel Group, thank you so much for joining us today. And of course, we're setting up for the broader market opens as well. And the Indian market is not really doing much, but we have seen, of course, the Nifty already at the highest level since January of 2025. We are watching some of those earnings that will be coming today, including from HCL Tech, also Tata Communications. So some of those names to watch. The Nifty Bank Index also higher in today's session. Coming up, U.S. Vice President J.D. Vance talking trade with Prime Minister Modi. India is now seeking to strike an early deal. We'll get the details of their meeting next. This is Bloomberg. The White House says trade talks between Vice President J.D. Vance and Indian Prime Minister Narendra Modi made significant progress. New Delhi is seeking to strike an early deal to avoid Trump's additional tariff hikes. Bloomberg government reporter Sudhi Ranjan Sen joins us now from New Delhi. Sudhi, so what does significant progress actually mean?
Well, I mean, what significant progress actually means is that the two sides have been able to kind of decide on the terms of reference, go and decide on the path to go ahead. Mind you, there is not much time. There's only 90 days time since the talks began, and India is rather interested in a way to kind of strike this deal and get, so that it can avoid being hit by the tariffs. The United States is one of the biggest trading partners of India, where India has a positive trade balance. It doesn't want to lose that. So, yes, I mean, for India, it's a very, very big thing. And the statement from White House, very encouraging and very, very promising, saying that there has been significant progress.
Will India be rolling out the red carpet for President Trump again? I mean, I remember during his first term how ostentatious that whole affair was. Well,
I mean, when the Prime Minister was there earlier this year in February, there was an invite that had been extended to President Trump, and that invite was also because India is hosting the Quadrilateral Security Dialogue, and the leaders are supposed to meet in India around September. That is what one understands. And President Trump is likely to be here. Yesterday, we saw the Prime Minister reaffirming that invite that he had extended to President Trump in February. We, on the ground in New Delhi, we do not clearly have an understanding whether there has been any communication from the White House accepting the invite. But the expectation is, since it is the Quadrilateral Security Dialogue, or the Quad, is all about China and President Trump's current policies on China, the expectation is that we would see President Trump visiting India to attend the Quad summit. But again, we must underline to our viewers, there is no commitment as yet from the White House.
Prime Minister Modi has a very busy diplomatic schedule. He's headed to Saudi Arabia next. What can we expect?
Well, it's going to be a very big visit, because India is looking not only at investments from Saudi Arabia, and it is also looking at new energy, and both ways. I mean, India is offering Saudi Arabia green hydrogen, which India is trying to ramp up production in. At the same point of time, looking at investments into India in the petrochemical sector. India and Saudi Arabia have a long-standing energy partnership. They also have a security partnership. They are strategic partners. We have seen the defense relationship going up between the two countries. So what one is expecting is some kind of an announcement from the two leaders on these fields, which is investment, energy security, and defense.
Bloomberg's Sudhi Ranjan Sen there joining us from New Delhi as we continue to watch all of the diplomatic overtures on that part of the world. Here are some of the other stories that we're following at the moment. President Trump says U.S. Defense Secretary Pete Hegseth is doing a great job despite what appears to be attacks from disgruntled employees. Hegseth is facing staff churn, a leak investigation, and a report that he shared sensitive military attack plans in a second unsecured chat group. A former Pentagon spokesman says the Defense Department has been overwhelmed by staff drama and turnover under the Trump administration.
This is what the media does. They take anonymous sources from disgruntled former employees, and then they try to slash and burn people and ruin their reputations. Not going to work with me, because we're changing the Defense Department, putting the Pentagon back in the hands of warfighters, and anonymous smears from disgruntled former employees on old news doesn't matter.
The U.S. has set new duties on solar imports from 4 Southeast Asian countries after a year-long investigation. It found solar manufacturers in the region were unfairly benefiting from government subsidies and selling their products to the U.S. at rates below the cost of production. The new duties affect Vietnam, Cambodia, Thailand, and Malaysia. That's it for Insight. Horizons Middle East and Africa is next. This is Bloomberg.